Today, we are wrestling with, I think, the biggest, most expensive question shaping the entire global economy right now.
It really is.
Are we genuinely witnessing the dawn of a foundational technological revolution, something that will define the next century? Or are we simply standing at the precipice of what might be the largest, most spectacular, all-consuming financial bubble of our time?
The bubble to burst them all.
Exactly.
And, it's not just an intense debate, it's a furious clash of evidence. Our sources for this are split right down the middle, presenting two highly conflicting narratives that are really fighting for dominance.
So what are the two sides?
Well, on one side, you have these detailed, almost apocalyptic arguments. They're presenting hard evidence of what they see as structural and financial instability.
Yeah.
This is the complete case against the current AI valuations.
They don't just see a bubble, they see something more sinister.
They see it as quintessential financial engineering fraud. But then on the other side, you have these powerful financial giants, you have analysts arguing that this boom is firmly grounded in real economic fundamentals.
So not speculation.
Not speculation. They're pointing to the balance sheets, to undeniable economic contributions. And so our mission today is to go deep into the specific numbers and I think the mechanisms both sides are using.
Right, because the comparison to the dot-com era, especially that late-stage telecom bubble, it isn't just growing louder, it's getting eerily specific.
It is. And that intensity is the key. The similarities, they go beyond just, high stock prices.
Okay, so where exactly does this current financial structure mirror that late 90s fervor?
It centers on three primary similarities, and I think they really define the fragile nature of this moment. First, just the scale of valuation expansion in the core companies is breathtaking.
We're talking trillions of dollars.
Trillions. Second, the sheer magnitude of this unprecedented infrastructure investment, the capital expenditure, the CapEx, we're seeing across the hyperscalers is just staggering.
And the third.
And this might be the most critical point. It's how the financial relationships are structured. We are seeing deals that completely blur the boundaries between who is the paying customer, who is the supplier, and who is merely the capacity provider.
The whole system is just running on a loop.
It's a loop of high-stakes financial faith.
And if that faith is misplaced, the consequences will be systemic. Okay, let's start with the hard-hitting stuff. We're calling this part one. The case for a fiery apocalypse, structural flaws, and fake demand.
I like it.
Let's unpack the most aggressive technological critiques first. We have critics like Ed Zitron, and his skepticism, it really roots itself not in finance, but in functionality. The root of his argument is incredibly blunt. Generative AI, in its current form, doesn't fucking work.
That is aggressive phrasing. But it cuts right to the core of the technological critique. The argument is that these large language models, the LLMs, are inherently limited by their probabilistic nature.
What does that mean in simple terms?
Think of them as extremely sophisticated prediction machines. They're fantastic at predicting the next word in this sentence.
Right.
And that makes them excellent at generation, at summarization, creative writing, that sort of thing. But that predictive skill is not the same as deterministic reasoning.
So it's not just a matter of waiting for a bigger, more powerful model to solve the problem. This is a structural ceiling that's built right into the architecture itself.
That's the argument. Exactly. The sources point out that these basic generation and summarization tasks, they're not what people, or more importantly, what businesses are looking for when they want complex units of work automated.
You can't build a global economy on summarizing meeting notes.
You really can't. And the fundamental constraint is this challenge of reasoning and reliability.
Let's delve into that reasoning problem. If the models are constantly getting larger and more capable, shouldn't their ability to handle complex logic just increase linearly with that?
You'd think so, but not without these severe efficiency penalties. While the models have certainly gotten more powerful, that increased complexity has led to what some people call a higher token burden.
A token burden?
Yeah. To perform complex reasoning, the model needs to process a longer chain of thoughts, sort of a scratch pad, to get to the answer. This demands exponentially more compute power, and it significantly increases the chance of an error.
So the more effort you force the model to exert on complex logic, the higher the internal pressure becomes.
Precisely. And here's the critical paradox. The more complex the reasoning effort, the higher the propensity the model has to hallucinate.
To just make things up.
Which ultimately makes the output worse, not better, for critical or complex tasks. You hit this point of diminishing returns very, very quickly when you demand sophisticated multi-step reasoning.
And that immediately raises the issue of trust, which has to be the necessary prerequisite for any kind of enterprise automation.
It has to be.
If you need 100% reliability for a critical business function, managing a supply chain, processing patient data, a complex financial transaction, a probabilistic model is just inherently inadequate.
That is the immovable obstacle in the road to generalized AI adoption. Automation, especially in these high-stakes regulated environments, it needs to be unilateral. It needs to be reliable, operating on defined, deterministic rules that a human can actually verify and audit.
And you can't audit a black
You
box.
can't, because LLMs are probabilistic. They can't offer that defined auditable rule set. I mean, they might give you the correct answer 99 times out of 100.
But that one failure could be
It
catastrophic.
could cost millions or be the source of a massive legal liability. Businesses just cannot delegate control of their core systems to something they can't fully trust.
Which means the technology is fundamentally limited to what? Augmentation tasks or low-stakes generation, which sharply limits its ability to monetize at the scale required to justify these insane valuations.
That's the argument. And that failure to generate hypergrowth monetization, you could see it clearly in the revenue numbers, even for the market leaders. Let's look at that revenue gap, specifically in enterprise adoption. The money being spent on compute is massive, yet the revenue seems, in the critics' words, almost negligible.
Okay, so the Microsoft Copilot numbers are used again and again to illustrate this failure. Unpack that example for us.
Right, so Microsoft has around 440 million, Microsoft 365 subscribers globally. It's a massive captive audience.
The ultimate distribution advantage.
Absolutely. Yet sources estimate that as of August 2025, after months of aggressive marketing and integration, they only had about 8 million active licensed users of Copilot at the full price point.
8 million out of 440 million. Wow. I mean, what is that conversion rate? I'm doing the math in my head. Yeah.
It's tiny. It's a razor-thin conversion rate of just 1.81% across their core customer base.
That is shockingly low for a product that's being positioned as the future of all work.
It is. Now let's do the math on the revenue. Even if we assume every single one of those 8 million users pays the full $30 monthly price,
Okay.
the maximum annual revenue generated by Copilot subscriptions is estimated at around $2.88 billion.
No, wait. In a vacuum, $2.88 billion is a phenomenal number for almost any new product, especially in enterprise software. So where do the critics get off calling that pathetic?
You raise a critical point, and this is where context is everything. Critics rightly point out that for a company like Microsoft, which reports just staggering revenue, their productivity and business processes segment alone pulled in around $27.2 billion in a single quarter recently. $2.88 billion annually is dwarfed by their existing established revenue streams.
So it's a rounding error for them almost.
It's an addition of only about 2% to that one segment's total annual revenue.
No.
It just doesn't justify the narrative of transformative hypergrowth that has propelled Microsoft's valuation increase into the trillions.
So the criticism isn't that the product makes no money. It's that the market cap increase suggests a new multi-trillion-dollar revenue stream, which this clearly is not.
Exactly.
It implies customers are profoundly underwhelmed, or they're simply unsure what the business value is beyond the initial buzz.
That is the core takeaway. If the market leader, the software juggernaut with the ultimate distribution advantage, can't monetize their AI integration effectively, it casts a really severe shadow over the entire ecosystem. It suggests the technology just isn't providing that must-have transformative value that's necessary for universal adoption at that $30 price point.
And we see similar performance issues even outside of Microsoft, right? What about the critique leveled against Salesforce's highly hyped Agent Force initiative?
Salesforce is a perfect parallel because they are banking so heavily on this idea of AI agents automating customer workflows.
Right.
Yet internal research cited by critics revealed a pretty damning operational reality. One critic cited an internal Salesforce research paper claiming their AI agents succeed only 52% of the time on single-step tasks.
Half the time. That's barely better than a coin flip.
It is a coin flip, and it gets much worse for anything complex. The same paper suggested that the success rates plummet to a truly abysmal 32% of the time on multi-step tasks.
A 32% success rate for complex mission-critical tasks. That runs completely contrary to the aggressive Agent Force narrative and the claims made by their leadership.
It creates a severe and unavoidable misalignment. You have CEO hype like Mark Benioff claiming AI automates up to 50% of work, And that's directly contradicted by this operational reality where the agents fail two-thirds of the time on complex tasks.
So you need so much human oversight that it defeats the purpose of the expensive automation in the first place.
That's it. And this is why we move from this idea of fake product performance to the most concerning point, the fake financial performance that's driving what you called the bubble to burst them all.
This transitions us perfectly to the most worrying financial accusation, these Enron-like mechanisms driving the spending bubble. This is where the debate shifts entirely from technological capability to pure, opaque financial engineering, all sustained by a single powerful engine.
And that engine is NVIDIA. The core accusation here is that the high valuations and the massive capital expenditures across the whole ecosystem are built on a myth, and it's sustained by what sources describe as an unhealthy obsession with NVIDIA's growth.
Because they're the sole provider of the necessary commodity, the H100 GPU.
They have the monopoly. So let's pull back the curtain on the circular spending model that revolves around NVIDIA and these newly formed specialized compute companies, the so-called neoclouds.
Okay, what is a neocloud?
A neocloud is essentially a data center or a compute company, like CoreWeave or Lambda, that focuses solely on renting out these massive clusters of AI-focused servers, and they're almost exclusively equipped with NVIDIA GPUs. Now, here is the mechanism that's raising all the alarm bells. The sources highlight that NVIDIA is not just a supplier to these companies. It's a significant investor in them.
So they're investing in their own customers.
Correct. But they are also frequently a guaranteed customer of the very capacity those neoclouds create. For instance, critics point to a massive arrangement where NVIDIA made a $1.5 billion deal in September to lease back its own GPUs from CoreWeave.
Wait, I need to stop you there. NVIDIA sells the GPUs, invests equity in the company that buys the GPUs, and then guarantees future revenue for that neocloud by leasing the very same GPUs back from them.
That's the loop.
That sounds exactly like ensuring immediate top-line revenue growth for NVIDIA and ensuring market absorption of its products simultaneously, all while artificially pumping up a neocloud's valuation.
It is absolutely designed to do that. And this arrangement is explicitly warned by some analysts to contribute to any bubble in AI investment because it creates manufactured demand and guaranteed revenue streams for companies that otherwise might really struggle to secure financing. They're using NVIDIA's future revenue pledge as collateral.
This arrangement sounds eerily similar to the vendor financing scandals that inflated the late 90s telecom and networking bubble.
The parallels are unavoidable. Critics are drawing direct comparisons to the vendor financing packages used by giants like Nortel and Sun Microsystems during the dot-com bubble.
Right, where they'd essentially loan the customer the money to buy their own product.
Exactly. They would sell networking equipment to customers using these incredibly generous credit terms, financing the purchase themselves, just to book the immediate revenue. And then when those customers inevitably failed, the initial revenue had to be clawed back in this painful wave of write-downs.
Are there financial indicators on NVIDIA's balance sheet right now that suggest this risk is materializing?
Yes. Sources point out that NVIDIA's accounts receivable, that's the money owed to them by customers who have bought equipment on credit, are climbing faster than its revenue growth.
That's a classic red flag.
It is. In isolation, it's not necessarily a fatal sign for a fast-growing company. But in the context of massive, circular vendor financing and an increasingly undiversified customer base that is highly dependent on debt, it raises serious concerns that those payments might not arrive on time. If CoreWeave or Lambda hits a rough patch, NVIDIA is exposed to potential future write-downs of billions and billions of dollars.
That is a powerful illustration of the financial fragility at the supply chain level. But this isn't just about these smaller neoclouds. We saw an even more glaring example of the market ignoring fundamental logistics with that massive, hypothetical Oracle OpenAI capacity deal.
That deal, which was reported to be worth up to $300 billion, is the perfect example of market frenzy just overwhelming basic physical and logistical reality.
Just a headline number that everyone got excited about.
Completely. Critics analyzed the deal and the sheer compute required. To serve a contract of that proposed size, where OpenAI would supposedly be paying $30 to $60 billion annually, Oracle would need a staggering 4.5 gigawatts of power capacity.
4.5 gigawatts. For context, that's equivalent to several large nuclear power plants, or powering a city the size of Dallas.
Precisely. It's an immense figure. Now let's look at Oracle's actual capacity. By the middle of fiscal year 2027, the time frame when that massive payment obligation is supposed to kick in, Oracle is only expected to have 1.2 gigawatt of total power capacity.
And that 1.2 is for all their cloud customers, not just OpenAI.
Exactly.
For everyone. So less than a third of the required physical infrastructure and power capacity exists, or is even projected to exist, to deliver on this contract, yet the market reacted with extreme euphoria to the headline number.
The reaction was described by critics as psycho. OpenAI cannot possibly afford to pay that amount without delivering massive proven profits back to its investors, which it has not done. And Oracle physically cannot deliver the compute capacity required within that time frame.
These are just hard physical realities.
They're panic-worthy realities. Yet the market, which critics describe harshly as being run by participants with the institutional knowledge and emotional intelligence of babies, ignored them entirely in favor of a great big vibe. The narrative is generating the value, not the capacity.
That is a devastating case against. It suggests that much of the AI boom's valuation is built on a foundation of technology that's too unreliable for critical use, and a financial structure that relies on artificial demand and capacity promises that cannot physically be delivered.
It paints a picture of systemic risk all the way up and down the supply chain.
Okay, but as you mentioned earlier, there is a strong counter-narrative, often coming from major established financial institutions, explaining why this moment is fundamentally different from the speculative frenzy of the late 90s. Let's transition to part 2. The rationalizers, why this isn't the dot-com bubble.
Right. And this counter-argument, it doesn't deny the circular financing critiques entirely. They acknowledge there's risk in the supply chain, but they argue that the financial architecture supporting the leading AI companies is structurally sound.
And the primary difference is what?
It's that the current valuations, particularly for the big tech leaders, your so-called Magnificent Seven, are underpinned by strong, established financial health, not zero revenue.
So the idea is that these are not just speculative startups with no business model like so many of the failed dot-coms were. These are giants that existed long before the AI boom.
Exactly. Today's technology leaders, who are the biggest beneficiaries of this AI narrative, they are anchored by real revenues, proven business models, and accelerating adoption. They aren't betting the house on a single, unproven idea. They have immense profitability, steady cash generation from diverse legacy businesses, and these healthy, fortress-like balance sheets.
But the valuations of these companies have soared into the stratosphere based on this AI growth potential. Surely that has to resemble the irrational exuberance of 1999.
This is where the financial metrics provide the critical distinction. Let's look at the price to earnings, the PE comparison. The S&P 500 Information Technology Index currently trades around 30 times forward earnings.
Okay, which is high.
It is elevated by historical averages, certainly. But at the absolute peak of the dot-com era, the S&P 500 Tech Index reached a monstrous 55 times multiple.
And that 55x multiple was based almost entirely on the promise of future earnings that never materialized.
They never came.
So while 30x today is high, the rationalizers are arguing it's grounded in accelerating profits, not just promised profits.
Precisely. The argument is that the current 30x multiple reflects a genuine massive acceleration on existing and proven revenue streams. Think about Azure, AWS, and Google Cloud, which are already generating billions in income. The dot-com 55x multiple, by contrast, was based on pure speculation about revenue streams that were years away from monetization, often for companies that didn't even have net income.
This disciplined approach also seems to extend to investor behavior. The capital flows don't suggest the kind of retail-driven hysteria we saw 25 years ago.
That's another powerful point for the rationalizers. Investor behavior today is demonstrably more disciplined. During the dot-com peak, we saw a massive speculative surge of $54 billion poured into technology mutual funds by retail investors. It was a frenzy.
And if we look at the current year-to-date figures,
The picture is completely different. U.S. equity funds and ETFs recorded net outflows of about $45 billion overall. Outflows. Meanwhile, technology funds did attract capital, but a comparatively moderate $14 billion in inflows.
That contrast is profound. It suggests that while professional money and large institutional funds are definitely moving into the established tech leaders, the general market sentiment isn't driven by that unchecked, get-rich-quick retail exuberance that characterized the late 90s mania.
It suggests a more targeted, measured optimism that's focused on the established winners, rather than a broad, speculative frenzy that just lifts all boats. And on top of that, the economic contribution of AI investment is already substantial. It's not just a promise for the distant future. The spending is tangible right now.
Give us the hard number that makes AI a genuine economic contributor today.
AI-related capital spending, so spending on chips, data centers, and advanced software, accounted for over 1 percentage point of the U.S. Q2 2025 GDP.
That is not trivial.
It's not trivial at all. That is a massive and meaningful contributor to immediate national economic growth.
So analysts are saying AI isn't just the technology story, it's a major macroeconomic factor that is literally driving the overall economy forward.
Exactly. Analysts view AI as the single most important macro factor for 2026. This investment cycle, anchored by companies with strong financial fundamentals, is accelerating growth and providing this powerful tailwind for the broader technology value chain, and it's offsetting other persistent economic headwinds.
Okay, so we have a profound conflict. Critics claim the tech is flawed and the financials are fraudulent, while analysts say, look at the cash flow and the GDP impact, this is structurally sound. To figure out who's winning, we need to move beyond the balance sheets and look into the trenches. Where is AI actually being used?
Exactly.
And this brings us to part 3, the reality check. Where is AI actually being used?
And this is the crucial reality check provided by the Anthropic AI Usage Index, or AUI. It gives us concrete usage data spanning 150 countries in all U.S. states up to August 2025. This data, it sort of bridges the gap between the financial hype and the real-world diffusion.
So what's the headline finding regarding the speed of adoption?
The adoption is unprecedentedly fast. The index confirms that 40% of U.S. employees now report using AI at work.
40%.
This is a massive leap. It's essentially double the 20% that was reported just a year prior in 2023. This is technology diffusing at speeds we simply haven't tracked before.
But the data also shows that this rapid adoption is highly concentrated, following a pattern that's similar to previous industrial revolutions, but on much, much shorter timelines. Let's look at that geographic concentration.
At the country level, the AUI shows an exceptionally strong correlation with income. Wealthier nations are leading the charge, and that reinforces existing economic structures rather than disrupting them globally.
For example,
Singapore leads global usage per capita, using AI at 4.6 times the expected rate based on its population and economic size. Canada follows close behind at 2.9 times.
why Singapore? Is it purely wealth, or is there a policy or a structural component there?
It's often a combination of wealth, robust digital infrastructure, and a small, highly digitized, knowledge worker-dominant economy. This income correlation suggests that, rather than leveling the playing field for emerging markets, early AI adoption is actually reinforcing existing economic divergences.
It's concentrating productivity gains in prosperous regions.
Exactly. And conversely, emerging economies like India at 0.27 times and Nigeria at 0.2 times show significantly lower usage.
The digital divide is becoming the AI divide.
And within the U.S., that concentration is also evident, showing that local specialization really dictates adoption. Which states are leading the charge?
D.C. leads per capita use at 3.82 times its population share, which is understandable. You have this heavy concentration of government, legal, and lobbying professionals who require heavy document processing.
Makes sense.
Utah is a close second at 3.78 times. And we also see specialization in the type of usage. Elevated use for IT and coding tasks in California, complex financial services in Florida, and, as I mentioned, document editing and career assistance dominating usage in D.C.
So the technology follows the highest density of knowledge workers and the most valuable, easily digestible data sets. But let's look at what the technology is being used for. Does that adoption pattern change as countries become more mature AI users? Absolutely, and this is where the index gives us a clue about the technology's natural evolution. In low adoption countries, usage is programming dominant. Coding tasks account for over half of all usage in India, for example.
And why is that?
Because coding is a high-value, highly structured, and easily automated task. It's the low-hanging fruit for this technology.
And as adoption matures in high-income countries?
In high-adoption regions, the applications diversify dramatically. Usage spreads across education, science, and a much wider variety of business functions. This suggests that the initial killer app is coding, but maturity brings augmentation to broader, less structured knowledge-based tasks.
Which reflects the need for that more complex reasoning we talked about earlier.
Exactly. And this leads us to the crucial metric that really separates the hype from the reality: Automation versus augmentation. This distinction tells us exactly how businesses are valuing the tool.
Okay, so this is probably the most profound finding in the AUI.
It really is.
Yeah.
Low AUI countries, the ones often seeking immediate efficiency gains, show a relative preference for full task delegation. That's automation. They're using AI to complete entire specific tasks, often because they lack the highly skilled human oversight that's necessary for deep collaboration.
And in the high adoption, more mature areas.
Conversely, users in high adoption areas show a preference for augmentation. This means more collaborative, learning-based interactions, more human-AI iteration. They're using the model as a highly effective brainstorming partner, or an intern, rather than delegating the entire function to it.
The index also separated out consumer usage like me interacting with Claude.ai via a web interface from programmatic business use via an API. This has to be key to understanding enterprise monetization. How does business usage differ?
The distinctions are sharp, and they support the automation is king business philosophy. While both API and consumer use focus heavily on coding, businesses, which deploy Claude programmatically via API, show a striking 77% automation dominance.
77%. So in 3 out of 4 interactions, the business is just delegating the task entirely to the model.
That's right. And if you compare that to consumer users interacting directly with Claude.ai, they show an automation rate of about 50%. Businesses use the model significantly less for educational or creative tasks compared to consumers. They focus heavily on tasks where full delegation is possible, like code generation, internal report drafting, or administrative summaries.
That 77% automation rate in enterprise API usage seems to strongly support the narrative that businesses see AI purely as a tool for efficiency and delegation, not collaboration, and they're willing to pay for it.
It does. It underscores that while the underlying tech may be limited in reliability, when it's deployed correctly within a structured business process, it is delivering real, measurable efficiency gains that lead to delegation. This, however, raises some serious concerns about labor market disruption, as the technology is clearly displacing workers whose roles are most susceptible to automation.
Okay, what about the high-cost argument that the critics lean on? If costs are so high that Copilot revenue is pathetic, but businesses are still adopting it heavily via API, does that suggest cost is actually immaterial to the early adopter?
For early enterprise adopters, particularly those dealing with high-value knowledge work, yes, cost appears to play an immaterial role, which means capability trumps price. The data shows a positive correlation between the cost of a task and its usage.
That's counterintuitive. Why would the most expensive tasks have the highest usage rates?
Because the economic value of successfully automating or augmenting a high-value task like advanced coding or complex financial modeling far outweighs the API price tag. The most expensive tasks, like those typical of computer and mathematical occupations, they tend to have the highest usage rates.
So it supports the idea that capabilities and the economic benefit you get from that capability determine adoption far more than the raw cost of the interaction itself.
It's all about ROI, not unit cost. If a model can automate or drastically speed up a high-value task performed by an expensive employee, businesses are willing to pay a premium for that capability, regardless of the API price tag.
But this leads us directly to the biggest bottleneck that prevents this technology from diffusing further into the economy, the problem of context.
The knowledge required to perform the task.
Yeah.
Complex deployments, especially in large established firms, require the model to access dispersed context.
What does that mean, dispersed context?
Things like tacit knowledge that's located across executives' emails, marketers' internal memos, or decentralized CRM systems. If that context is dispersed, messy, non-standardized, or just locked in legacy systems, the model is useless for sophisticated tasks.
And correcting for that must be the most expensive part of the adoption cycle.
It is the major constraint. The need for context implies that firms have to undertake these costly, multi-year data modernization and organizational investments just to centralize and standardize that dispersed information. This inherent organizational inertia and the immense fixed costs of adoption suggest that initial AI deployment will remain highly concentrated in specialized tasks and among large, well-resourced firms that can afford that data transformation.
This brings us right back to the fundamental financial conflict. Regardless of the current adoption figures, both the critics and the cautious analysts agree that the market structure is fragile and an inevitable correction is coming.
And we can already see that fragility in the market volatility. Just consider the reaction to NVIDIA's earnings report on November 20th, 2025. This is a critical moment.
What happened? NVIDIA had a blockbuster quarter, right?
They absolutely did. They beat Wall Street expectations, and the CEO explicitly stated that the new Blackwell platform sales were off the charts. This should have been a massive victory lap for them.
But it wasn't.
No. The market reaction was violently volatile and ultimately negative. The stock jumped 5% in early trading, fueled by the excitement, only to erase all those gains and close down 3.2% on the day.
That suggests profound underlying nervousness.
That reaction, immediately following a genuinely strong earnings report, it just shows the deeply fragile core of the AI rally. The fear is so palpable that a minor piece of ambiguous guidance can override exceptional historical performance.
And because NVIDIA makes up, what, 7 to 8% of the S&P 500?
Its movements disproportionately affect the broader market. The tech-heavy Nasdaq closed sharply lower that day, down 2.2%.
This volatility just shows that investor sentiment is the thin line holding the whole valuation together.
Exactly. And the investor Ray Dalio weighed in on this, even after that strong earnings report, stressing that the bubble talk is not over. Dalio stated clearly there's definitely a bubble in markets.
And what's his reasoning?
He emphasizes that bubbles don't burst because people suddenly realize the profits aren't there. They burst when sentiment shifts and people decide they need to trade financial wealth, these assets with inflated, faith-driven values, for hard cash. When that cash for asset trade begins, the system deflates, and it deflates rapidly.
So if this inevitable correction occurs, and the bubble pops, maybe not completely, but significantly, who gets hurt the most? Who are the victims of this immense financial transfer?
The most vulnerable segment is undoubtedly the retail investors. They've been heavily invested, often through index funds or concentrated ETFs, in the Magnificent Seven, particularly NVIDIA and Microsoft. A significant correction is going to directly damage people's retirements and their brokerage accounts.
Because they bought the narrative at the peak.
They did. And then what about the AI ecosystem itself? The thousands of AI startups that have been funded by VCs over the last 24 months.
It's going to be ugly.
It's expected to be an extinction-level event for AI startups. Because the technology is so resource-intensive, requiring these massive front-loaded capital expenditures for compute, many of them lag any clear path to independent profitability.
You're just wrappers around the foundational models.
That's what critics argue. They're easy to clone, they lack proprietary data moats, they will die or be acqui-hired, bought just for their talent stack.
And the venture capitalists who funded them.
VCs are facing a massive reckoning. They have jettisoned so much capital into AI startups at increasingly inflated valuations. When those companies fail, the VCs will struggle significantly to raise new funds for years because losses will be historic. The financial damage is going to ripple through the entire private market ecosystem.
Let's return to those specialized compute providers we discussed earlier, the neoclouds. Given their central role in the circular financing model, they have to be highly vulnerable.
They are arguably the most vulnerable entities in the entire supply chain. Critics describe these niche AI compute companies as debt vehicles wearing computer hats. Their whole model relies on securing massive amounts of debt, often collateralized by the promise of future GPU contracts from NVIDIA or the hyperscalers.
But if they're so dependent on the hyperscalers, what happens when the hyperscalers decide they don't need them anymore?
Their entire business model evaporates. Their primary customers, the large hyperscalers like Microsoft, Meta, and Google, are often just temporarily using these neoclouds to avoid raising their own CapEx guidance in the short term, just to keep their balance sheets looking leaner.
So it's a temporary stopgap.
It is. The moment the hyperscalers build out their own internal capacity, which they are rapidly doing, these neoclouds, which rely on debt that has to be repaid, will collapse. For instance, CoreWeave has $25 billion in debt and reportedly lost $300 million in one recent quarter. None of this makes sense in a sustainable financial context.
That's terrifying fragility. Now, what's the ultimate fate of the major dependent players, specifically OpenAI, which sits right in the middle of this hype cycle, totally reliant on Microsoft for its survival?
One critical view suggests OpenAI will likely die and get absorbed into Microsoft. The logic is really simple. Microsoft already owns all the IP, it controls the infrastructure via Azure, and it runs all their research operations exclusively.
The operational costs are staggering.
They are. And when the financial pressure mounts, Microsoft would simply take the valuable parts of the OpenAI, stack the models and the talent into the Microsoft cloud, eliminating the need for the partnership structure entirely.
So the underlying technology survives, but the independent company does not. And even established hardware giants aren't safe if their AI forecasts prove to be too optimistic, like Broadcom.
Correct. Companies like Broadcom, which was anticipating billions in revenue from specialized AI chip rollouts for clients like OpenAI, could be significantly harmed if those rollouts prove to be only modest, as some reports suggest, rather than the exponential growth they forecasted. The fundamental challenge that unites all the critics remains the same.
And what's that?
If AI companies were honest and sold their product as an intern that is useless without constant costly hand-holding, they would never achieve their current astronomical valuations. The valuation is based on the myth of fully autonomous, reliable automation, which the technology cannot currently deliver.
So let's bring this tension to a close and try to synthesize our findings. We've established that the market stability is supported by the massive economic contribution and the strong balance sheets of the largest tech companies. That's the rationalizer's argument, which structurally distinguishes this moment from the pure speculation of the late 90s.
Right.
And we also have confirmation of real, rapid automation-dominant adoption, primarily concentrated in high-income regions and industries, which is backed by that Anthropic index data.
However, that seemingly solid foundation is severely undermined by two critical weaknesses that make this boom feel like the ultimate financial bubble.
Okay, what are they?
First, the technological limitation of probabilistic models that prevents mass adoption for critical, complex tasks, which caps the total addressable market. And second, the unprecedented, potentially unsustainable level of capital investment fueled by that circular spending and the vendor financing mechanisms, particularly those involving NVIDIA and the neoclouds.
So the core conflict remains. While today's AI companies show real profitability metrics that distinguish them from the zero-revenue speculation of the dot-com era, the specific financial behavior in the supply chain and the complete lack of broad, justifying revenue streams outside of a few specific tasks mirror historical bubbles built purely on faith, not on consistent, justifiable monetization.
The question isn't whether the tech is useful. It's whether the valuation is structurally honest or engineered for extraction.
And if we look at the extreme logistical impossibilities, like the Oracle OpenAI capacity gap, coupled with the reliance on these debt-fueled neoclouds, the weight of evidence suggests the current market is focused almost entirely on vibe and narrative, rather than capacity, revenue, or fundamental technological capability.
The money is flowing to the narrative, not the product performance.
Okay, so we've established that early enterprise adoption is currently automation-dominant and capability-focused, even if it's costly, and that this adoption is highly concentrated in wealthy regions. Considering the evidence that early adoption tends to reinforce existing inequalities by concentrating productivity gains in prosperous regions and among sophisticated users, that divergence we saw in the AUI data, here is the provocative thought we want to leave you with. Will the eventual financial reset prove that the greatest value created by the AI boom was not the efficiency it provided to a select few firms, but the immense wealth transfer it facilitated before the bubble inevitably bursts?
An interesting question, especially when you consider who pocketed the profits from all that circular financing. The wealth transfer itself might be the ultimate and most lasting economic consequence.
Something to mull over. Thank you for diving deep with us. We'll see you next time.